Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, December 30th, and this is the last video for 2022, bidding a not so fond farewell to 2022 from a market perspective. Very difficult bear market. Managed to just close just below the minus 20% level into the end of the day today. Uh, let's get right into it. This is the Big Show edition where we'll take a look back at the prior week, take a look ahead at next week, and update the world famous 21 over 21 leaders list. State of the market in a correction. You can check the trend gauge over here. Leaders, still plenty of them holding up okay, but by holding up, again, that means they're exhibiting relative strength but not making price progress. Very rare that you'll find something making a breakout and continuing higher, and that's just a hallmark of a bear market. The market likes to play whack-a-mole with stocks like that. So we're neutral on leadership. As far as the five major indexes go, and where they are relative to their moving averages, all five below their declining 21-day exponential moving average. So that's very clearly a downtrend there. Medium term, we've got 50-day moving averages trending higher or flattening out, and price for the five below it, one above it, the Dow still holding up. So we're mixed there, neutral with the red sub arrow. Long term, all major indexes below declining 200-day moving averages with the exception of the Dow. So we're in a downtrend there with a yellow sub arrow indicating the strength in the Dow. So what happened today? Let's flash back to yesterday. Let's flash back to Wednesday, where we had a breakdown which looked like it was going to be kicking off, going lower, another leg lower as we had finally closed below the key 3,800 level. Overnight, the market said not so fast. We gapped up Thursday and had a strong day, but ran right into 3850 resistance. Um, over a 90% up day. A lot of people got bullish, but it was mostly a junk rally, and the market said not so fast to the upside and gapped down overnight. 7/10 on the S&P to the downside, 1% on the Nasdaq, but couldn't press any lower. So we opened up about 3820, chopped around for a little while. Afternoon tried to break down to the 3800 level. We knocked on it 3 times before a strong bounce into the close. So what happened today, we'll call it a gap down and a PM rally into the close. We actually closed at the high of the day despite closing red across the board. So here are the numbers. G6, this is our 6 ETF growth composite, up down 0.21%. S&P down over 1% at one point, almost 1.2%, but rallied 1% into the close, closing down 0.25%. Nasdaq 100 was weakest all day, ended up being strongest by the end of the day, led by Tesla and Apple, both finishing green, down 0.06%. The Dow down 0.2%. Mid caps down 0.44. Russell 2000 small caps down 0.28. Global diversified 60/40 down 0.53. And you can tell by that number that bonds were weak today across the board. Bond prices down, which means bond yields were up. In-house GROTECTION, we were basically straight on flat on the day. Some accounts down a couple dollars, some up a couple dollars. Depends on rounding errors in share counts for the individual positions. So for the week, the G6 down 9/10, S&P down 0.14, Nasdaq down 0.4, Dow, mid caps, Russell all down less than 0.2%. Bonds lagged on the week, so 60/40 was down 0.43%. In-house GROTECTION down 0.14%. We'll hit the tail of the tape and then the updated 21 over 21 leaders list. Only 2 stocks dropping off, and one of the ones dropping off was an inverse ETF that we'd been playing. So that actually indicates strength in the financial sector, or at least not as much weakness. So let's get to the indexes now. First of all, we'll start off with the S&P 500 here. You can see what was looking like a lower low. We'll go to a 15-minute chart. You can see the breakdown below yesterday's low and the strong move into the close, closing at the highs of the day. This 3850 area only held for half day. We got to see what happens when we challenge it next week, or if we challenge it next week. Can't wait to see next week. Going to be extremely interesting with all the crosswinds blowing. Some people are going to argue that this a gap up. The first 2 days of the year are traditionally strong, as they're the final two of the Santa Claus rally, where people front running it. This last hour and a half, hour into the close, we will see when we open up Monday night on the futures, as the market is closed Tuesday, celebrating New Year's a day late since it falls on a Sunday. So there's your S&P 500. Let's look on a daily chart here. Basically making it closed right on the 80 MA, a tenth of a percent below, very similar to where it closed yesterday. Below the 21. This is day 11 below the 21-day moving average. But if you look at a 60-minute chart here, you can just see how tight we've been. One day above, one day below. Really a tight range here between 3,800 and 3,850 going back to mid-December, with a couple of exceptions. Let's go to the NASDAQ 100. So the last couple days, minor relative strength. This is primarily caused by Tesla finally stopping going down. Note, all the stochastics have hooked up from oversold. They haven't left oversold. They're at the bottom, but the stochastic and the MA has hooked up on the major indexes. We're sitting right on the downtrending 80 MA for the NASDAQ 100. Let's go to the leading index, the Dow. Closed right on the 50-day moving average. 50-day moving average has got a pretty strong slope higher. Next week, it's going to meet the downtrending 21-day moving average. You're seeing triangles formed here. The declining tops along the highs over the past week and a half, and then bringing up the bottom of the last week and a half, and it's going to break one way or another next week. That's what we'll be keeping our eye out for primarily. MDY mid caps, all of those, again, all those moving averages, all four of them converging between 440, even the 443 and 448, very tight. A lot of resistance overhead from a moving average standpoint. Let's look at small caps here. Not looking too strong. Relative strength, at least they've stopped going down more than the market, as you can see over the last 2 weeks, sitting right on the 8, but under the 3, the short term, the medium term, and the long term moving averages. But again, they've hooked up off of oversold and are trying to get out of oversold. In fact, it closed above the 20 level there, which signals oversold on the index. Let's go to the VIX. Continues up a little bit today, was up much worse, but reversed, actually closed at the low of the day, which is typical. It's in line with the inverse correlation with the indexes below the 21-day EMA, which is now flattening out. The dollar was weak all day today. Stocks didn't seem to care. They were weak all day, except for that last hour. We actually undercut the 1220 low on the dollar and bounced a few pennies above it, sitting right on the close, or actually right on the low from 1220. So we ended the year on the dollar at lows that we hadn't seen since the end of June. So all that strength for the third quarter turned into weakness for the fourth quarter on the dollar. How about bonds? Here's BND, Broad Bond Index, sitting right on the 50-day moving average, very tight range over the last 4 days. How about junk bonds? A little bit of a scare on Wednesday, but they've reclaimed it Thursday and Friday after Tuesday, Wednesday down, sitting right on this 90 level below the key moving averages. However, I mentioned bond prices were down. That means bond yields were up, still in a tight range over the last 4 days, and we're now into overbought on the yield. TYX. Here's the 30-year. That was the 10-year. Again, forecloses above the 50-day moving average, getting into overbought. Let's check precious metals. Very weak on the dollar. Should gold be up? It should be, but not a whole lot. Up 0.5%. Riding the 80 MA and the 21 EMA higher. Let's look at silver. Continues to ride the 21 and the 80 EMA higher. GDX, this is where the disappointment kicks in. These were negative on the day, and basically right on the 21-day exponential moving average. The metals continuing to outperform the precious metal stocks. So those are the major indexes to review. Let's get to the tail of the tape now, and then we'll get into the 21 over 21 list. Technically, weakness in the markets, they don't go down forever. We've been going down for 2 weeks, 2+ weeks, since Jay Powell and the Fed said higher for longer. But we've stopped going down very clearly at this 3,800 level on the S&P. Stochastics have hooked up now for the indexes and the G6. VIX at 2167, very low. No panic whatsoever there. Fear and greed at a 37. We're operating under the bear case. Need to break strongly and initiate a rally above the 21 EMA to get off of the bear case. Some news: Chicago PMI came out at 9:45 Eastern time, and it was stronger than expected, and the market took a little bit of a drop then, but really traded tightly most of the morning until we tried to break down and failed, and then rallied into the close. Day count from up one to up one with a consolidation. I actually had this as up one to a down one at 3 o'clock today and had to change it after that last hour rally. Expectations neutral, mixed day, strong, weak in the morning, strong in the afternoon, averages out to about a mixed day. S&P and NASDAQ 100 held their support levels again. Let's see what was strong today. Bond yields up as bond prices were down. Silver and gold finished positive. Oil's positive. Retail, aerospace, biotech started out weak, finished positive. XBI did. IBB finished about flat or down a little bit. Dollar down. 9 of 11 of the spider sectors down. Led to the downside by utilities and real estate. These focus names are what we own. They'll be reviewed when we go over the 21 over 21. Only portfolio change today was to sell UDOW into the afternoon strength, lowering our adjusted beta from 0.15, cutting it in half to 0.07. Bottom line, gap down, but 3,800 holds firm again, and then a rally into the close. We will see where next week takes us. Going to be one of the most interesting weeks. The continued strength. Oh, by the way, the Santa Claus pivot 38.22. We closed a 0.5% above that now with the close at 38.40. So the Santa Claus rally, in effect, really amounted to nothing the first 5 days, up barely a 0.5%. Nothing exciting this week. You could tell by the closing numbers that we showed that it was kind of a ho-hum week, but a lot of fits and starts inside, which is what happens in a low volume holiday week very frequently. So let's get to the 21 over 21 list now. We'll start off with what got punted out, and FAZ got punted out, and that's because XLF, the financials, showing relative strength over the last week. We sold this into strength on FAS or into weakness on XLF, and it is basically close enough to the 21 that we don't need to keep it on the list anymore, especially with the stochastics turning up. I know it's in a lot of resistance here, and this could take a dump very early next week. I'll set my alerts over the weekend, and we'll be ready for it if it turns down again. And then the other one that was punted was Yum China, a way to play China without actually playing China with the open, but coming into oversold now and a break and a close below the 21. Other than that, 19 of the 21 stocks held up. So let's start off with the two that we added today. Ulta uh, has been on the list in the past, finally went through a correction after this really nice rally up along the ADMA, reclaimed the 21, showing nice relative strength over the last week and a half. And the second new one was GE, and the reason that's on there, I mentioned last week, GE Healthcare being spun off next week. This has been showing strength in anticipation. I've read some things about people really wanting to get this healthcare piece of it, as healthcare is considered the crown jewel of what's left with GE, their most profitable division. And putting this on here to keep an eye on what happens when this finally does spin off at the middle of next week. And then these are the carryovers from last week. Schwab trending higher nicely along its ADMA. Crocs, here's one that stuck its head out, won't go any higher, but at least it didn't get smacked back down below this 100 level, closing at the highs of the week at 108.43. Caterpillar flagging. This is the normal action when something tries to break out, knocked back down last week, knocked back down again this week as it tries to break above 240. Halliburton, uh, oil services continue to show strength. This now at the top of its handle and that 40 level. AVGO, strongest of the semiconductors, just going sideways along the 21. Lennar, just going sideways now since the nice report on earnings, not making any progress, but not breaking down either. MDGL is that big gap up on news, follow through to the upside. Still hasn't touched the ADMA yet. The 300 level appears to be resistance. NVO continuing to trend higher along the ADMA. SMAR bounced off of the 21 right around the 40 level. Shift 4 payments got a big upgrade yesterday, gave back some of it today, but did close in the top of its range as it bounced along the ADMA. This is one that poked its head out, and its head is still sticking up. You want to monitor these to see if the market is going to allow some growth stocks to run or if it's going to come and get them all. UTHR going sideways, bouncing along the 21. GDX, this, as I said, closed right on the 21. Can't stay above the 200. The stocks themselves are lagging gold, but it is a big sector that is setting up near the top of its range for a move higher. If we get that, whether or not we get that strong break higher, thought we were getting it here. This is when we got into NUGT. Not so fast, my friend. TMDX. Closed at 2-week highs. That's pretty good. This is one of our remaining holdings in the portfolio. ELF continues to hold up around the 21 EMA. SARK, this is inverse Kathy Wood, down 2 days in a row since ARK-K was up 2 days in a row, breaking the ADMA. They did a 5-for-4 split this week. Stochastics rolling over, which means it might be time for ARK, on the other hand, to start running. But for now, it's just a 2-day pullback and a strong uptrend. Five Below, undercut. We got stopped out here when the market was still before the Fed. I was using this model, expecting the bounce off the ADMA that lasted for 2 days before it undercut. Then two closes below the 21 got us out. But as is so typical of a bear market, where you out or scary out, you got me out with the two closes, and then it rallied a few percent above the 21. Boeing continues. This is another one that we still hold, continues to just act very well. Relative strength flagging over the last week above the 21. Mobileye, this is the third individual name that we're still holding. Undercut and reclaim the 21 on a show of strength yesterday. Higher close today. In fact, it closed at the high for the week. And STNG, midweek, I had this on the this may get cut list, but it bounced right at the 50-day moving average. The strongest stocks that break the 21 hold the 50. There are a bunch of them that just roll over through the 50, but the strongest ones bounce and reclaim the 21, and that's what STNG did. And that is your 21 over 21 leaders list. Remember what we do here at Revere: active management. Why do we do that? Because of this little ditty right here. This is the table that should keep you up at night if you've got your life savings in the market and you're under the 200-day moving average. That's where all of these bear markets occur. That's why we pay so much attention to this big black line here, the 200-day moving average. This is where all the trouble in the market historically takes place. All of these occur under the 200-day moving average. On average, it's about a 12% drawdown from the top till the break of the 200. And then if you're going to see subsequent moves lower, they occur below the 200-day. Sometimes it's just another 8, 9, 10, 12%, and it's just a fairly average bear market. Sometimes it can really turn harsh, and that negative sequence of returns is what can chew up your nest egg that you saved your whole life for. So that's why Risk management is our number one job here at Revere. And if you're interested in this approach, give me a shout, don@revereasset.com, or my partner, Dan Stewart, dan@revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. So wrapping up the week, the month, the quarter, and the year, this is Don Vandenbord reminding you it's not how much you make in the market, it's how much of that you can keep, protect your capital, wait for the wind to be at your back. We saw the last 8 months in 2020 what a roaring bull market can do. Followed through not with growth stocks, but the indexes were strong in 2021. Gave a good bit of that back in 2022. Let's see what next year brings. We've got a recession on the horizon. The question is it priced in, or are stocks really going to take it on the chin? We're prepared either way with rules to handle any situation. So, wrapping up December 30th, this is Don Vandenbord telling it like it is. Just the facts here at Revere. Happy New Year to everybody, and we'll catch you on Tuesday night. Tuesday night will be the next video, and make sure you check out the podcast this weekend. Our newest intern, Connor Bates, made his debut on there, so be sure and check that out. Thanks for listening, and have a great weekend.